to the Employer Link webinar series presented by McAfee & Taft. My name is Brad Neese. I'm Managing Editor of Employer Link. Today we'll be talking about taking control of the renewal process for your company's health plan. We'll get to that topic in just a moment, but before we begin, I'd like to take a moment to let you know about a couple other things we're working on right now. First, a quick reminder about our next webinar coming up on July 18th. Employment attorneys Kathy Neal and Sherilyn Whiting-Ralston will discuss best practices for handling harassment complaints, including practical tips for properly investigating the complaint, how to deal with the complaining employee going forward, and what you can do to help avoid costly litigation. And you can find more information about this webinar at employerlink.com. Also, as I'm sure you are already aware, all eyes are on the U.S. Supreme Court right now as we await its landmark decision tomorrow regarding health care reform. Bill, you and I have visited about this quite a bit in the last few weeks. I know that you and the entire employee benefits team will be analyzing the decision as soon as it comes down and determining its impact to the laws already in place, as well as what it ultimately means for employers.
Thanks, Brad. Well, we were just discussing that this morning with our employee benefits group, and we do not know which way that opinion is going to go. So we are working on two different email blasts for Friday. One, that it's upheld and business as usual and, not going to be a lot of changes. Or the second email blast is the mandate's been overturned and now we have havoc. So we will let you know on Friday what that answer is going to be. And
we will be providing those updates and analysis not only by email alert but also on employerlink.com. And as soon as we determine what we're going to do on the webinar, we will also post that there as well. Now, just a few notes about today's presentation. This program has been approved for 1 hour of general recertification credit through the HR Certification Institute. And for those of you who pre-registered for HRCI credit, we will be sending a follow-up email in the next day or so with program details. Second, on your screen, just below the slide presentation area, you should see a tab called Supporting Material. And with that, you can download a PDF version of today's presentation materials. And right next to that tab, you should see another tab called Ask a Question. And there you can submit your questions electronically during the presentation. Please keep in mind, though, that we are not able to answer case-specific questions. And I will say that there's a lot of information that we need to cover today, so it's possible we will not likely or it's possible we won't have enough time to answer the questions before the end of the broadcast. If that's the case, either way, we will post the answers to the most frequently asked questions by sometime early next week on this webinar's resources page at employerlink.com, and we'll also provide a link to that page when we send out our follow-up survey. Our panel today features McAfee & Taft employee benefits attorney Bill Frudenrich, along with Todd Neese, an employee benefits and risk management consultant and president of Premier Source. Premier Source has been at the forefront of helping employers implement cost-saving strategies by digging deep into company health plan data and analytics to identify those areas which significantly impact plan performance and the bottom line. Now, to start off today's topic, I want to lay the groundwork with this little tidbit. For most employers, providing health care coverage is one of their largest expenses, typically representing the second or third line item on their budget. And it seems that each year that cost goes up and our options seem more and more limited. The renewal process certainly doesn't seem to make it any easier to effectively manage this major expense. Employers are so crunched for time during the short renewal window that there's really not much opportunity to seek alternative options and additional savings. Even more frustrating is that it seems that the insurance companies and brokers have all the control over what the plan looks like, what options we have, and how pricing will be affected. Bill, I know you work with a lot of employers. How can employers shift that balance in their favor so that they have more control in the whole process to keep those costs manageable and have more options when it comes to plan design?
Okay, Brad, that was a mouthful, but let's see if we can pare this down. Now, as the benefits attorney, I am not the expert on helping you with your renewal. That's Todd's job. But I have a lot of clients who go through this every year, And it's the same frustration of, okay, 30 days before my renewal, maybe 3 weeks before my renewal, I get a spreadsheet from my broker, and it's basically take it or leave it. Well, today Todd's going to talk about some different possibilities, some things that you should be doing on a proactive basis. One thing I want to say is a lot of the things that you're going to see at the beginning of this presentation you've seen before. It's a good reminder. It's a good refresher. If you take anything away today, I think you should pay very close attention to the very end of the seminar when he starts talking about internal underwriting. And what that's going to mean is internal underwriting is basically where you take all of your data, you take it to an independent resource, actuary, consultant, broker, whoever. They're going to take that data, they're going to enter it into a system. Basically, it's an actuarial system, and they're going to reprice your case and tell you exactly what the cost of your plan should be. Now, with that, I'm going to turn it over to Todd. And, Todd, if you start talking over my head and everyone else's head, I'm going to stop you. So
that's a great introduction, and the chances of me talking over someone's head is remote, but I know that and understand how jargon can certainly be misunderstood and hard to grasp, and so we will certainly try to make this understandable for everybody. I think one thing I would say before we kind of get started is to also reiterate something that Bill had mentioned, which is that the purpose in a large degree with this seminar is to help you understand the need to prepare, the need to think ahead, the need to plan. That's if you come away from this presentation with anything, I hope that you come away with that, that there is a way to think ahead through this process and not necessarily be trapped and have to react to the renewal or react to the numbers that are presented to you. We wanted to give this opportunity to be out ahead of most of your renewals. And I would say, too, that, and that's the reason for the timing of this presentation, but I would also say that these each one of you that would be here on this call are different. You're unique. You have your own individual situations that we have to discuss. You might be a small group that's fully insured. You might be a large group that's fully insured. You might be self-insured. We're going to try to attack all angles of this. We're going to go through a lot of different aspects of the renewal as it relates to fully insured and self-insured. The statements might be a little general to some degree in order to try to speak to the masses here on this call. However, I know and we know that each case is unique. Each case has its own unique aspects that would have to be discussed. So I would encourage you to, again, take from this presentation the aspect of preparing, the aspect of planning ahead, and these tools that would be available to help you do that, and to be an active participant in this process. So we'll go ahead and get started, and I think the first way to kind of maybe broach this subject, Bill did a great job of kind of getting us started as far as the reality of our world today and the way it is responded to from an employee benefits perspective. You get a renewal, you usually don't feel like you have time to do it. So really, there's nothing. I don't tell good jokes, but I think that truth is usually some of the funniest things that can happen to us. And I think that you would say that from this gentleman's perspective sitting behind the desk, he would not think that this is acceptable to simply say we have lost $500,000 in the fog of accounting and not having any explanation behind it. But I think that this is something that we do see that happens quite often, where we say simply that your health plan has increased another $500,000, and a broker and or the carrier itself simply said that that's a competitive price. A broker simply says, I took it to the 5 markets and this is a competitive renewal. I don't think that you would find that acceptable either. And so this seems to me to be something that is of reality. It speaks of reality. So it's something that we're certainly mindful of, and I'm certain that this is something that many of you out there understand. So as we get into this, what are some of the keys? As we talk about keys to obtaining a hero status, I mean, how can we go through this process and look through this? And as I stated to you earlier, we really feel that the aspect of being active, taking an active role in this is going to be really critical. Don't automatically resign yourself, as we mentioned here, to your renewal. I think it's very important to start early in the process. Now, something to kind of be mindful of, when we talk about starting 120 days out, maybe 180 days out for self-insured plans, the idea here is to plan. The idea here is to set a strategic plan in place that you can work towards. You don't want to be too early in the process when you request a renewal, when you ask for the information. And the reason why, if you're fully insured, for those of you listening out there, if you're fully insured, that renewal, if we ask for it too early, there's going to be an increase that the underwriter has no choice but to load or increase your rates because of the unknown. They simply do not know what's going to take place in the months that they don't have. It's interesting, but we're not pricing for a can of green beans that's going to be on the shelves next year. We're setting something up that could be extremely costly, and they're having to project a cost that's going to go out next year based on the information that they have presented to us. So if there is an unknown, meaning months ahead of schedule that they do not know what it is, we're going to get a load that is not described other than simply to say that that we're too early in the process. So you don't want to be too early. You also look at this from a self-funded standpoint. The stop-loss companies, they're going to give you a contingent renewal. They're going to give you something that would not be considered firm or solid. They'll give you a contingent number and wait until about 90 days prior to the effective date. So when we talk about these dates, we're really talking about dates that you want to make sure you start the process. You want to make sure that you're getting out ahead of the process, gather your data, taking an active role again. Demand more from your carriers and your brokers. More information, analysis, and time to make changes. And again, I go back to not necessarily from the perspective of when you want that renewal released. We'll get into that. But also from the perspective of making sure that you're out in front of it, making some of the changes that we'll talk about later in this presentation as far as some internal underwriting tools. So then we get into some of the key areas that are influencing renewals. And these are, as Bill had mentioned, these are things that many of you would see. But when we talk about significant swings in utilization patterns, we're really talking about things that would cause underwriters to pause and look at a case a little bit differently. If you have an outstanding claims year, the year prior to your renewal, but yet your history has been that for the most part you've had rough claims years. You've had quite a bit of costs and utilization from a claims perspective. That underwriter might look at that one particular claims year as kind of an outlier. They're going to look at that as those swings in utilization patterns don't necessarily give them a sense of consistency in your claims. So that's something that they obviously take a look at. In-network and out-of-network claims, certainly as many of you know today, it's important to make sure that we're in a good position on that as well. And having in-network claims. Go ahead, Bill.
Now, Todd, before we go on, when you're talking about in-network versus out-of-network, we were talking earlier today about how you have a case, and truly the claims really should be paid in-network and they're being paid out-of-network. Would you suggest that there be an audit of these out-of-network claims or a little closer scrutiny with the out-of-network claims?
Yeah, the out-of-network situation obviously does not allow for there to be the contract to be followed by the provider signing a contract that they agree to the terms of that particular contract. So having some type of, if you see something to where there's an extreme number of claims that are being paid on an out-of-network basis, definitely should raise a red flag as far as having some type of audit done by an administrator, by a carrier, to see if that is indeed the case. The in-network provider piece is critical from a pricing perspective for a carrier's underwriter to make sure that they're getting the revenue that they need and that the plan's costs are being held down. We'll talk about more of that here later. But that's going to be critical in how your underwriter renews your case and what they run out there with a renewal. So yes, absolutely. If we see something, and we have seen this here lately, where claims are paid on a significantly high out-of-network basis, we want to address that, and we want that to make sure that that's looked at with greater scrutiny by the administrator. Accurately measuring realized discounts as well. Not only are you getting the most aggressive discount, do you want to look at that, but also want to make sure that the utilization is going there. To Bill's point, we want to make sure that the in-network policies and the in-network piece is being utilized at a high level, but also with good discounts. So we want to make sure that's taking place. Other areas that we talk about as far as influencing renewals, large claims above the pooling or stop-loss levels. This is a huge issue. This is something that, and we'll talk about pooling and stop-loss here in a little bit to help you better understand that for those that are fully insured and self-insured. But large claimants obviously give underwriters a tremendous amount of heartburn. These are claims that obviously typically are very expensive, but many times they might have an ongoing nature to them, and we have to make sure that there's some type of plan in place to address that. But that is something that an underwriter is going to take a close look at. The administrator's ability to truly manage claims. Does the administrator of the carrier, do they force appropriate levels of care and find some ways to have a strong progression towards discharge? You want to make sure that the claims are managed in the right way, in a good fashion. For those of you who are self-insured, having a high auto adjudication rate, now that is just simply auto adjudication, meaning that the claim comes into the administrator and it's immediately paid. They don't really take the time to pull that claim out, make sure that it's running exactly the way it should. That's an area for those that are self-insured to make sure and to address with your administrator. Ask the question of how many of your claims are auto-adjudicated, again, meaning that it just slides through the system. It's automatically paid electronically. When that happens, many times your plan and the claims aren't managed appropriately and can just go through the system without having someone make sure that they're being paid as you have written the plan to be paid. So that's something that we want to make sure. And that's something that an underwriter, it definitely influences their renewal process when they see that the claims aren't managed appropriately. Last thing I'll touch on as well is more from the standpoint of something that we discussed in our May 3rd seminar on wellness. We talked about how an underwriter looks at metabolic syndrome risk factors, and certainly you can see in the points here, the bullet points, that obviously individuals that have these particular factors, high levels of the blood pressure, triglycerides, waist, circumference, HDL levels, and fasting glucose, when they don't hit certain levels that are ideal, the numbers simply show that those people will contribute a higher degree of additional cost to the health plan, 70% of additional cost when we take out inflation as well. So it's important from an underwriter's perspective, what types of wellness programs are in place. We do have other wellness data here that we've shared in our May 3rd seminar as well. Something that I would say, though, is do you have, or first of all, the question being for each one of you, do you have a wellness program in place? Something that an underwriter from a fully insured plan, they take that very seriously. You'll see many carriers today that will discount their renewals and or just at least offer wellness programs. I should probably phrase it more that way, that they'll offer wellness programs at a very significantly reduced price to have these wellness programs put in place for their clients in hopes that it will reduce the plan costs. It is something, though, that, as we talked about in our last seminar, it is something that is long-term. It is a long-term strategy. It's a long-term play. You have to be patient. It takes a long time for wellness programs to start working itself out. But you can see the cost differences of a 500 life plan, and certainly saying that not all of you are at that level. We understand that. But it gives you an idea of what kind of costs would be associated with a 500 life plan that will need to have a significant number of their enrollees in the membership not have any costs at all in order to offset the claims for type 1 diabetes, type 2 diabetes, and cardiovascular disease. So wellness programs are significant, and they can certainly add to the ROI. So now that we've kind of gotten a sense of maybe some of the factors that influence your renewal, the background behind this, and taking an active role, what are some of the heroic opportunities to improve your renewal that you can kind of look at and take advantage of as we move through the presentation? If you're fully insured, kind of as we talked about, being involved, understand and review your renewal worksheets, all right? This is going to be something that in many situations, I think most of you have depended on a broker or a consultant to provide that data for you, and that's very important. But I also think it's important for each of you to take an active role in that process as well. Understand that, and we're going to provide you with some data here that might be helpful as you go through that process. Monitoring the discounts between insurance carrier networks. Certainly if you're going to make a change, you want to have an idea what those discounts might look at. We'll talk about discounts later. We'll also talk about direct contracting. What does that mean? How does that influence the cost structures between facilities anymore?
Todd, I have a question. You say monitor discounts between insurance carrier networks. Isn't that information proprietary? How do I do that?
It is, and it is. They will provide, carriers will provide average discounts. Depends on the size of your case, but I will say that there is no really strong and accurate way to determine the best discount, and there are so many factors involved in it that makes it very, very difficult to do that on a very good basis. Many times when you get that from your carriers, by the way, too, when they say our average discount for inpatient is X, our average discount for outpatient is Y, when you get that information, it's based so many times on the best discount for that particular code. Not necessarily all codes are going to be at that same 52% discount or whatever they might say. So it is very much, to your point, Bill, it's very difficult to monitor it. I do think it's important to at least get as much data as you possibly can. There are ways to at least kind of pull out the ones that are somewhat effective and those carriers and networks that maybe are just simply not quite as effective when it comes to discounts. So, but you're right, it is very, very difficult. So something to definitely look at and keep in mind, as Bill pointed out. Ask for an early renewal. Again, as we talked about, you don't want to be too early, but obviously you got to have more of an opportunity. And I would say that the strategy here would be, again, as we talked about from a timing perspective, plan. I think that's the most important thing. Get ahead of the game. Develop the process, put the process in place where you're getting data, but also plan for that renewal. What kind of plan design changes would you want to make? What's your budget look like? These are things that you can do. But ask for that renewal on an early basis. If you're fully insured, it's okay to request that renewal to come out, hopefully in 90 days. You wouldn't be too far outside of 90 days. Typical standard is 60 days that they would release the renewal. If you're not getting the renewal back by just within that 60-day mark, that would be something that you would want to address with either the carrier or the broker. That needs to be released to you, at least from a knowledge perspective alone, and the process can still work itself out as far as the marketing process if need be, but 60 days should be the minimum of when that renewal gets to you. So 90 days is not outside of where you would like to be either, so it's something to kind of pay attention to. Pooling charges, and we talked a little bit about this, but remember, you do pay pooling charges, and the idea to eliminate large fluctuations in experience. So when you get the worksheet from your carrier, it's important to recognize what they consider to be the pooling charge. Where do they consider those claims to be?
Okay, Todd, I'm going to stop you right there. What is a pooling charge? Is that a swimming pool, or what is that?
It's not a swimming pool. It is 110 degrees outside. It is not a swimming pool to relieve you from this pressure and this pain. Pooling charges, probably the best definition that I would be able to think of in regards to this audience and the different groups that we might have here. From a pooling perspective, if you're at a certain size, there is, and meaning more on the smaller end, insurance carriers are trying to reduce the fluctuation that could take place with a large claim. So they pool all groups based on size. They'll pool them all into a particular category. So when we have claims that have hit a certain mark, those claims then are released from the own individual company's claims experience and thrown into the pool. So it helps the smaller groups, if you will. It helps them, and it helps the underwriter too, underwrite more consistently for groups where a large claim can significantly change their numbers. I think how that's important for those of you out there that are going to be fully insured and are going to have to that would have to pay attention to the pooling charge piece is simply to say that that number can be a variable number based on what the carrier suggests, and it can have an impact on your renewal. So it's something to be mindful of. But again, the pooling charge itself is a premium that would be charged to pay for those claims that go outside or large claims that go outside a certain size group. It's thrown into the pool so they then can more consistently rate smaller cases.
Let me ask you a question. Can I go to my carrier and say, I want a pooling charge at $50,000, or I want a pooling charge at $100,000, or do they set that themselves?
They do. They set that themselves. I think from the perspective of the carriers, the most important piece, I think, is to have someone on your side of the desk that's able to discuss the value of what that pooling charge would be, have a legitimate discussion with them to where maybe you can have certain other variables discussed within the underwriting process. Sometimes you might have a carrier that's willing to kind of look at it, but it merits discussion. It merits negotiation. It's something that they don't do often. They have a particular process when you're fully insured. So many of the insurance carriers look at this based off of efficiency, and so they're going to want to maintain that same pooling charge level, but it's something that could at least be discussed.
But if I'm going to my fully insured renewal, that's a good question for me to ask if I have catastrophic claims. What is the pooling point?
That's exactly right. That's going to be a critical piece in how, or at least it's going to be something that you'll want to know as you go into that process, and it does impact your renewal. It absolutely does. All right, so when we talk about being wary of a carrier using just that most 12 months worth of claims data, really what we want to see is that's very important to use. Possibly more than the first or the most recent 12 months of data, but we want to make sure there's greater credibility given to the most recent year. Now, certainly if you're one that has had a significant amount of claims that have taken place in maybe previous years, and that 1 year is going to be stronger and help you out more, we want to give greater credibility to that most recent year if that's going to be helpful. If it's not going to be helpful, then we want to try to see if there's a way to pull in previous years to help you offset maybe that last claims year doesn't have a great number to it and you've had a lot of claims in that year. Let's see if we can pull that in. But what I would say is at least it's something to be mindful of, and again, give greater credibility to the most recent year is something that's important as well. And then the retention piece, we'll discuss this, but it is something that the carriers each have different variables in which they can rate a case. So retention is simply it's the fixed cost piece. In most simple terms, it's the fixed cost piece of every insurance underwriting. And what I would say is that don't be fooled by the prospect that an insurance carrier does increase their renewal if they have a good sense that the broker that is quoting this renewal markets every year. There are variables that are put into the renewal process that increase that for the prospects that renewal is going to come down if the if the broker continues to market it. So they factor that in. There's a load in there for that particular process. So that's for those that are fully insured. If you are self-insured, same thing stands true, that we want to make sure that we understand and review the renewal worksheets. We want to look through that, take an active role again. We've talked about in the previous slides about the network changes and direct contracts. What I would say is make sure you're finding appropriate networks and cost structures. This definitely influences your plan costs. When you are self-insured, there is the ability to find direct contracts, and that can have a very strong and significant impact on your cost structure. When I talk about direct contracts, directly contracting with a medical facility that can provide you with a better cost structure than something that is within a PPO network. So that is something to at least evaluate, take a look at. That is something that you'll want to look at as the renewal is in place.
I have a question on that. So what you're saying is say I'm with a local network here in Oklahoma City, that I have my base network, but then I'm going to go out and contract directly with a certain hospital or a certain clinic and direct. Now, why would a hospital or a clinic do that?
The hospital and the clinics see great value in prompt pay. They see great value in not having to go through the claims adjudication process where they have to file a claim through an insurance carrier and go through all the processes that they have to go through today. There are great advantages to it, that in and of itself, plus the ability for one particular medical facility to feel that they're going to get a significant amount of members in your plan to go to their facility for care really makes a big difference.
Well, and the direct contracts that I've worked on, is it correct? What I'm seeing is on a lot of these direct contracts, we're waiving deductibles, co-pays,
right.
and that we're trying to steer toward that clinic. Now, that clinic is going to give us a better discount than what we ever have with what I would call our baseline HMO or PPO or whatever that discount is.
Right.
Correct?
Right. Definitely. We see much greater value in being able to encourage employees at a very, very strong level, as Bill mentioned, waiving deductibles, waiving coinsurance, being able to put something together that makes great sense to move something in a very strong way, move something to that particular facility. the reinsurance can be a pooled product. Your reinsurance can be pooled, and there are some carriers that do pool this. Now, when I'm talking about this, it's a little different. That's a different definition than what we talked about with fully insured pooling charges that we talked about earlier. Point being is that some reinsurance carriers, if you are self-insured, some reinsurance carriers will write you individually as you are, just as a case alone. Certainly, if you're large enough and you provide greater credibility to them, they don't have great fluctuations in your claims process. They can determine that more consistently. But there are some carriers on a reinsurance basis that pool you with everyone else. Now, that means that if you've had a really, really bad year, you're probably going to be the renewal's not going to be quite as bad because you're going to get offset by their clients that have not had quite as of a bad year. And then if you've had a really good year in a claims perspective, your renewal might not be quite as great, only in the sense that you're helping out those in their pool that have not had as great of a claims year. So that is something that you need to be mindful of. Not all the time when you're self-insured do you stand on your own. I would say, lastly, specialty pharmacy and the injectable programs, this we're seeing, obviously, as many of you probably know, we're seeing huge increases expected in this area. Heard recently that many people believe that in a short period of time on the pharmacy side, we're going to get to generic drugs and we're going to get to specialty drugs. And specialty drugs, and these are injectables that cost $1,500 to upwards of $4,000 a month for these injectables, extremely high-cost prescriptions. So where these prescription drugs can be purchased, if you're self-insured, can also make a huge difference in your reinsurance contract. It can make a huge difference if you have lasers. It can make a huge difference in your cost structure. So something to be mindful of.
Now, how do you structure that type of specialty drug benefit under your plan?
That's something that I think is very important from your end too, Bill, on the legal piece. We want to make sure that the plan document is written that it addresses, high-cost claimants, injectables, and where those prescriptions can be purchased. It also is very important that you're going to almost the source. Is there a way to negotiate directly with the source of those injectables? Now, there are some injectables that have limited distribution channels that you just simply cannot negotiate. But there are others that you can, and it's important to try to identify when you can and go in the direction that would best from a cost structure for you as a plan.
Now, so if I have a specialty pharmacy and I have a physician that's treating me, do we contract directly with the pharmacy, and then that pharmacy is then going to send the drug to the physician to administer the drug?
Yes, right.
Now, do all physicians like that? Because I know some of them make a markup on the drug that they're administering.
They can make a huge markup, and no, the physicians are not always happy with that new development, but that is something that is important on a self-funded basis, that you're working to the benefit of the plan. And so if there's a way to move outside of that current structure, it would be something very important to do. The physicians definitely can make a lot of money on just injecting that particular drug, so it is something to be mindful of. Okay, so as we get into starting to evaluate your options and looking at fully insured versus self-insured, certainly this is, if you're large enough, this is a question that I'm sure many of you have heard many times. What should we do? What makes sense? Should we stay fully insured? Should we be self-insured? We're going to kind of try to address this a little bit. Maybe give you some areas of questions and that you can look at, some alternate options that you can look at. So in taking a look at this, obviously if we just break this out, and as Brad had mentioned, we're going to see something on a healthcare reform perspective tomorrow from the Supreme Court that's going to address this in many ways. But as you know, and this is just a typical breakout. Now, for those of you who are small cases, you'll see, and we talk about from a small case perspective as it relates to healthcare reform, you see 80% as a level that you probably heard quite a bit about from the insurance carrier's perspective. And from healthcare reform, when you read the newspapers today, they have to be in a situation where they're paying claims at 80% of the level. And again, as we talked about retention, so we see retention there, and retention would be the fixed cost that a carrier has to try to fix into their rate, and that needs to, for again smaller cases, needs to equal the 20% level, offsetting the claims of 80%. Larger cases are going to be at 85% as it relates to healthcare reform today. One thing I would say, though, is that carriers can underwrite at a loss. Many people don't realize that. And I think that for many carriers, they look at this opportunity as being, wringing their hands. They've got to fit within 85 or 80%. Carriers make money on investments. Carriers make money on PBM contracts and also PPO networks in some cases. So there are ways that carriers make money at a loss. So let's say they still underwrite this case, your claims run well above 80%. They are still able to make some money within that particular plan. So as this thing, as your claims piece gets closer to 95%, and so somehow they're going to have to work in a 5% level to pay premium taxes, broker fees, and turn on their lights and pay their staff, they are still able to get additional funds and additional monies and revenue from different sources. So it's something that you need to keep in mind, as especially you go through this renewal process. Typical components of a self-insured plan. I think one thing that's important to note is that from a self-insured perspective, obviously your fixed costs are quite a bit less. So when we get into retention, we're seeing administrative fees maybe running at 6%. Typically, stop-loss rates and premiums that relate to stop-loss may be running at about 7%. So if we see claims running at 87%, 90%, that's a good number. I think one thing to note, though, is from a stop-loss perspective, it's important that we keep that at an appropriate level. So I believe that it depends on your risk tolerance level. We'll talk about that later. But risk tolerance, what you feel comfortable in taking on, what risk do you feel comfortable in taking on as it relates to your company? As much risk as you can take on, we start reducing that 7% even further down. More of your dollar can be given to paying claims and or not paying out unused or additional dollars that you don't feel are necessary. So let's talk about some of the similarities between fully insured plans and self-insured plans. Basically, you're going to have claims either way. You're going to have claims that are going to be in a fully insured plan and a self-insured plan. I do say, and I will say that this is something, though, that the claims perfection process, if you will, is something that you need to evaluate. Carriers pay claims in a certain way, and TPAs and administrators, third-party administration companies and carriers on a self-insured basis pay claims also. They might pay them a little differently, and you need to be aware of that. You also, as it relates to a self-insured plan, have the flexibility. We'll talk more about that here in a minute, but you have the flexibility to design the plan the way you would like. So carriers handle all the services, whether you're fully insured or self-insured. We also have, as we discussed, fully insured plans using the term pooling more often. It's a similar concept with self-insured plans, basically providing protection, but the self-funded plans are going to use a specific stop-loss for each individual. They're going to use an aggregate stop-loss for the overall group, but providing protection over and above claims that go over a certain level. We want to do that whether we're fully insured or self-insured. It's important, unless you are a very significant-sized group and you can afford to be completely self-insured, and we don't have many that do that, frankly. So you have to be in a really unique case to be able to perform that. So both have inherent fixed costs as well, which we talked about. We talked about the retention piece. So every one of them have fixed costs. So now let's talk about the advantages of a fully insured plan. Sometimes it's just best that you just write a premium check and be done with it. Sometimes it's best that you don't have to worry about the fluctuations in claims that you're going to get from a self-insured plan. So from a fully insured perspective, the consistency of premium, you know what your amount's going to be. They provide you with the renewal. They provide you with the premium, the number. You know what that's going to be. We're going to be able to know exactly from a budgetary perspective how much those costs are going to be, and you're not going to have fluctuations. And for some of you, it's best that that's the case. There are many opportunities for flexibility being self-insured, and we'll talk about that here more in a second. But from a fully insured perspective, there's a process that's more tied down. You have a premium that you need to pay. Sometimes that's best for everyone. Smaller groups probably should be fully insured in most cases, almost always, depending on the size. Very much the recommendation would be that they be fully insured because, again, it helps in providing some type of a pool rating, a community-rated type of plan, depending on the size again. And also, you don't have to worry about, when we talk about liability today, no liability today beyond those paid premiums. when you have a plan, you don't have to worry, a fully insured plan, you don't have to worry about those run-out costs, if you will, and we'll talk more about that, but basically claims that have a lag to them that are coming in after you have canceled your policy. You don't have to worry about that liability and paying those claims. So there are a lot of moving parts to being a self-insured plan, not as many moving parts, obviously, being fully insured. So for some people, that's a great advantage. As it relates to self-insured, basically the question needs to be asked, are you ready to be an insurance carrier? Because essentially when you're self-insured, that's the role that you're going to take on. You're going to take on and provide your own plan with greater flexibility. You're going to have the opportunity to cash flow. Let's look at this from the perspective that your claims simply don't run as high as the insured or fully insured plans premiums would denote. So if that's the case, cash flow certainly is there for you. I do think it's important, though, for those of you who might be evaluating this, I think it's important to prepare. Maybe that means you're funding at a maximum level, so you need to think about that. Lower administration charges usually are something that you will find in a self-insured plan versus a fully insured plan. From an unbundled services perspective, you most often have the opportunity to have lower cost structure when you unbundle things. The costs just simply aren't as high in many respects with each individual component of the plan. You can find efficiencies there. When we talk about eliminating taxes on 90% of the plan, really I think something that's important there is that with your fully insured premium, you have to pay premium taxes on that rate. From a self-insured perspective, that is much, much smaller. As we looked at that stop loss being 7% of the overall plan versus really premium on 100% of your plan, that 7% stop loss, for instance, and that's an example again, you pay premium tax on that amount. I would say as somewhat of a helpful reminder, I think it's important to understand that if you're using a broker or consultant, that commission level is taken out of the stop loss. It would reduce your plan just a little bit from paying premium tax on that level too. So I would look at doing something along those lines. And certainly if you're self-insured, it eliminates the state mandates that fully insured plans that they have to be mindful of.
Now, Todd, if I'm a self-funded plan, is it a correct statement that only a self-funded plan is going to be able to do these specialty things like have the specialty pharmacy benefit or actually do direct contracting with a what I call a specialty hospital or a specialty clinic?
Right. Yes, that is the case. Those opportunities are available to self-funded plans. And again, keep in mind just the statement of you're going to be operating as an insurance carrier. So in a sense, you're able to design your own network and do what you would like to do from a cost structure. Design the plan that you want to design. When you're fully insured, you're paying premium, you're ceding your risk to someone else. You have to fall within their structure and do not have the flexibility, as Bill mentioned, to design your own network. So when we look at steps involved in funding, in a funding analysis, what do we want to take a look at? We, again, have to find out what your risk tolerance level is. Is this something where you are okay with taking risk and understanding the fluctuations that could take place? Are you okay with being an insurance carrier? For the vast majority of you that are currently self-insured and any of that might be looking at it, the ability to take on that fiduciary liability, are you prepared to accept that liability of what happens if a claim is denied? How is that going to impact you all as a company? That's something that needs to be addressed. And I think just the basic philosophy. It's almost more a philosophical decision than it is a financial decision. You need to decide if this is an area that you really want to go down, and is that something that can be put in place, and you appreciate the value and the features and benefits of being self-insured. So more so, the financial piece is icing on top. It's a benefit, and I think most often for many employers, you will find that at the end of the day, many save money when they're self-insured as opposed to a fully insured premium. But to Bill's point, and something that we are going to be discussing here shortly, I think it's critical for each of you, whether you're fully insured or self-insured, to go through the step of predictive modeling and finding out what makes sense for you. In this case, it's finding out what makes sense for you on a self-funded basis, but I think it also makes sense, as we will discuss, on a fully insured basis as well.
Now Todd, what's predictive modeling?
predictive modeling has different definitions to some degree. I think what we're discussing here is to say, you'll find some predictive modeling definitions to say they're able to predict high-cost claimants, that you have claimants that fall in particular categories. They're high risk, low risk, medium risk, and what their costs are going to be down the road. There's a predictive modeling aspect to that. We're looking at predictive modeling from the perspective of how would your plan's costs be impacted if you were to make a plan change? How would your plan costs be impacted if you were to do something more along the lines of internally underwriting your case up front? Let's predict and model what your plan looks like with a tool on your side of the table versus waiting for that insurance carrier to provide you with that data. So we're looking at it in that regard as well. Predictive modeling as it relates to a self-funded case, though, does it make sense, Bill? Does it make sense to be fully insured? Let's kind of model those cost structures if you were to be self-insured. So you need to do that comparison. As we go through the steps involved in finding out whether or not you should be self-insured, though, this checklist, and I won't go through this, but this checklist for each of you, depending on what your category would be as far as the size is concerned, up to 100 lives, 100 to 299 lives, 300 plus if you're fully insured. Really, to be self-insured, data is critical. You have to get data. But really, when you're also looking at being fully insured, and as you're expecting your renewal, use this as a baseline to say these are the types of reports that you should expect to get either with your renewal or in front of your renewal. One thing I would say as it relates to utilization reports with 100 to 299 life groups, we talk about getting that on an annual basis. There are some carriers that can provide that on a quarterly basis. The reports are rather general, but yet it's still a report that provides data and can, again, help you take an active role, help you be up front and in front, a proactive approach to this process. When we talk about on a self-funded basis, again, you have the numbers, the reports there available to you. From a self-funded perspective, administrators today are able to provide critical reports and great reports. The ad hoc availability that most administrators have today, their ability, frankly, to provide ad hoc reports would be something that you would want to evaluate in that process. Reports that could be generated that are available to you to address the questions that you might have. It's important for that to take place. So these are reports that are available to you, also the reports that you should find most often. It gives you a little bit of a checklist.
Now, Todd, before we move into this next portion on internal underwriting, I just want to make some comments about internal underwriting. I didn't know what internal underwriting was 3 years ago, and I've now been exposed to it. It's something that a lot of large consulting firms and actuarial firms are offering. My clients who do internal underwriting, they love it. And the reason they like it is in the past they would get this renewal 30 days before it was due and say, hey, here it is, take it or leave it, and I'm the CFO or I'm the HR person, and I got to walk into the CEO or president's office and say, we got a 13% renewal, and they're like, what? Why? And you're like, I don't know.
Right.
That's what they tell me. But now I can walk into that office and say, hey, we're getting a 5%, 10%, or even getting a reduction, and I can go through this internal underwriting process and actually explain why we're getting it, or this was our quote, but since we had internal underwriting, we can actually go back to the carrier and say, no, we're not going to accept that because our analysis says it should be X, Y, and Z. Mm-hmm. So I'll just turn it over.
Absolutely. No, that's exactly right. That's a great way to help us understand and again remind us of what we went over just a minute ago with the comic strip almost. I've never met a CFO, especially, and certainly CEOs that like surprises. And I'm sure that those of you out there are in the same boat. We have to look at this from a proactive basis, and the tool to be able to do this on an internal underwriting basis is just to give you, again, something on your side of the table. What makes sense for you? Let's look at this ahead of that renewal being delivered, what those costs could be, what a good, very valid and good system that provides great data. What's it saying? What is that information saying as far as what my numbers should be this upcoming year? It's not necessarily an exact science, although I will say it's an extremely reputable tool. Many of them that are out there are provided by and designed by underwriters that have and actuaries that have great experience in this. So it's something, again, to have on your side of the desk and negotiate with the underwriters that are negotiating these renewals to give you. So why is it important? Bill addressed this as well, addressed it from the perspective of, again, not reacting, not being surprised, being ahead of the process. So when we talk about this particular process and going through the internal underwriting, and we'll talk about this in greater detail, but basically it provides you with that checks and balance system. Provides you with the ability to, again, have, as I mentioned, have this tool on your side of the desk as an employer instead of having that tool available to just the underwriters with the insurance carriers, having this on your side of the desk. I think that gives them, again, a very reputable negotiating tool that's something that you're able to use. Markets get busy. You find sometimes with a lot, especially for those of you, most of you are January 1 renewals. It's an extremely busy time. Can there be errors made? Sure, it happens all the time. Many of them, many underwriters, if they have to kick out a lot of renewals, sometimes don't look at the details in as much of a strong process as they should. And so this helps provide that checks and balances system as well whenever mistakes do happen. Again, strong negotiating power, have that information on your side of the desk again. It helps you to know when an increase is warranted. Again, we went through a lot of data earlier. Getting that data, knowing the specifics of each individual underwriter and each individual carrier is very important to know how that relates then to an internal underwriting piece. But you have a better feel for when you're about to get an increase, what that increase might look like, and then when you're thinking that when you get it, maybe that's not necessarily warranted, and you're able to respond accordingly based on the information that you already have. So when we go through this process and helping us to, again, take control of this situation and be proactive as we addressed, having the ability to understand the basic assumptions and considerations. We have to go through that process if we're looking at this internal underwriting. Again, every carrier is different. Every carrier is unique. You need to be able to understand some of those decisions that an underwriter goes through. So this is, again, is taking an active role in that process. And again, understanding the key areas that influence any plan's renewal. We just went through those to kind of give you all some background as far as what would an underwriter kind of take a look at. What are some of the key points that they look at and help us in going through this internal underwriting perspective. Opportunities to improve the renewal position, and also understanding what makes better financial sense, being fully insured or self-insured. The internal underwriting system can provide all of these components for you. So when we talk about underwriting considerations, we went through many of the swings and the influencers of a renewal, but what are some of the underwriting considerations, just to give you somewhat of a basic rundown for that insurance underwriters have to go through? They're going to look at the carrier persistency. How long have you been with a carrier? That makes a difference. If you are switching carriers each and every year, you're going to get an artificial increase in your rate, knowing that your history, that carrier is looking at your history thinking, I'm not going to keep this case for a long period of time. So they're going to inflate that renewal or that number for that particular purpose. A rate history, obviously it's very important for them to know what your history's been, especially when you're smaller. It's a smaller group. It's the only way, absent claims experience, which as you could see in the chart that we gave you, the checklist of reports, it's the only way to provide that particular data. Is to look at your rate history, see how carriers rated your case, gives them an idea, the other carriers gives them an idea of what your claims experience would look like. Large claimants, enrollment stability, and participation. It's very critical for an insurance underwriter to understand how many people are on your plan and how many people are participating. They want to have a good spread of healthy versus sick. Future employer contributions, financial stability of the group, composition of the group. What does your age, sex demographics look like? This is important for them as well. Industry represented. There are certain industries that take a little bit more of a different approach to negotiations than other industries. Underwriters take that into consideration. They take car dealerships, construction groups. They take the different components of these particular industries into consideration when they underwrite a case. Reasons for the group's existence, you have to understand your group health plan. So you have to have a reason for existence other than just the fact that you are in place.
Todd, I'm going to step in here for just a second. We're approaching the top of the hour, and I just want to just remind everyone that if you have to leave at the top of the hour, I don't want to rush the presentation. There's good information in here. We will have that archived version on the web by the end of the day, so if for some reason you have to drop off before we're done, you're welcome to go back and listen to that.
Todd? Thanks, Brad. We will go through the rest of this relatively quickly, though, as well. So we are getting close to approaching the final part here. But this is the part that Bill had discussed earlier. What is a piece that's very important for each of you to understand the value of an internal underwriting piece? We just talked about all the components and being fully insured and self-insured and the underwriting that goes through that process. But really, if we could leave you with the planning ahead piece, being proactive, thinking ahead of your process, very critical, but also if you would understand that this internal underwriting piece, regardless of the size of your plan, is very important. We have some screenshots that we are showing here that I believe, Brad, are also going to be available to employees. I think this is going to, or to the folks listening, that it's very difficult to see on their website. So the information that we have in front of you is just a little bit of somewhat of a screenshot, again, of the tool that we use. There's more components put in place here, but one thing I wanted to simply point out is the value of the pooling point in this particular case. This is a fully insured renewal, and you can't see it here, but we have a standard pooling point charge for the case of $50,000. The desired pooling point, again, keep in mind, these are claims that you get above this point. This claim then goes into the pool. It's thrown out of your own individual company's existence, if you will, if it goes over that particular charge. So when we get to that point and we have something that's on a $100,000 basis versus what we might look at on a $50,000 basis, the next slide will show us that that makes a big difference. So when we're looking at a rate change with the $100,000 pooling point example of 3.9% rate variance, and now we're looking at, if we were to look at this instead of a $100,000 desired pooling point charge, we're looking at it at $50,000. So we've lowered that pooling point level. And so in doing so, we're able to throw out a different level of claims. We threw out, in the first example of at $100,000, we threw out $118,000 worth of claims in the current year. Now, when we lower that number, we're now throwing out $225,000. Again, every case is unique, so we can't just say that this is the way it would work out for all of you. But for a particular example like this, moving that pooling charge, and that pooling point, I should say, down to $50,000 has reduced that from 3.9% to 1.8%. Simply wanted to point out with each of you that this process should be more involved than simply getting a spreadsheet 30 days in advance and saying, here are your options. There's more to this process, and you, again, have to take an active role in this process.
So basically, Todd, if I have my insurance, I'm on the McAfee-Taft Health Plan Committee, and as we come up to our renewal, which we do internal underwriting, since we have actually learned what that is over the last year to 2 years, because we never did it in the past. Right. But truly, this is something that if you're a group and you're struggling with medical costs, you need to make sure your broker or consultant has the ability to do this.
Absolutely, yes. And I think, again, it just helps you in getting the right number. People don't appreciate the example given earlier with the cartoon, just the way in which an individual has no answer for what's happened. This at least gives you an answer, and it helps you get ahead of the process. We've given you another example on a self-funded plan. Obviously, from a self-funded plan's perspective, we've got to factor in the fixed costs that already, frankly, are factored in on a fully insured arrangement that's factored into the underwriting process. But we've got to factor that in here on a self-funded basis. That's very different depending on the administrator. So we have to know that. So we wanted to show you at least what that might look like. And I would also say the other key component, which we won't go into these in great detail, but the other key component of internal underwriting is to be able to help you plan for plan design changes. So be out ahead of that process, be out ahead of the renewal, and discuss with your representatives what kind of changes would you like to make? What do you think are appropriate within the culture of your plan? What can you have within the plan that you think would be appropriate from a benefit perspective, but also what would that cost difference be? Instead of going back and waiting on the underwriters from an insurance company to provide you with that data, have that data at your fingertips, and that gives you the key benchmarking observations. This is just an example. If we were to look at benchmarking data and what would be appropriate for inpatient hospital copays, outpatient surgeries, and so forth, and then what the current plan has, and then give you data around that, then we model that. What would those variances be? What would the relative value be of a particular plan change? And you can see that on the next slide. It gives you just a screenshot of what that value would be. So now you understand that with one particular plan design change, it could have a 1.5% decrease in your overall medical plan charges, and the changes to your medical plan, it can have a 1.5% decrease. So then when we're looking at overall, and what we do and we sit down with our clients is to say, what's that estimated cost impact going to be? So would these plan changes be appropriate for you as an employer? We want to make sure that we're lining that up for our clients to make sure that they're seeing, here's what we estimate that particular plan design change to be. So the strategy of internal underwriting is to get you ahead of the process, but it's also to say, this is what we anticipate that renewal to be. But it's also very important to say, again, ahead of the renewal, ahead of when you have no time for changes. The margin is very tight. It's very close. You have 30 days to renew. You don't have time to make those plan design changes, and people don't make good decisions when they have to do things on a reactive and very quick basis. So that's our almost plea to you all today, is to say there's a value in this. There's a value in this particular process that I think each of you should look at very closely. So as we look at this, as we wind up here, does it work? And I have a particular example where worked with a municipality that had union negotiations with their police and fire. And in that particular self-funded plan, the police and fire union wanted their copays back. They wanted a predictable cost that they had not had. The plan, the employer, this municipality, had taken away the copays in the belief that it would just increases their claims utilization, the usage of their plan. It just increased that because it made it easy for them to go to the doctor. But the union wanted the physician copays back into the plan. And so when we looked at this with our internal underwriting system, we were able to see that there is a place, there is a particular copay at $40, at least as it relates to this plan. And again, every one of you are unique. But as it relates to this plan, we were able to see that at a $40 copay, there was a claims neutral cost. There was no cost increase to have a $40 copay. So now the union is happy. The union is happy in the fact that they have a predictable cost again. They know that when they go to the doctor, it's not $67.22. It was $40, a straight $40, and they knew that. But the municipality was also happy knowing that they would not have an increase in claims. So again, this was ahead of the process. It's something that was an outstanding tool to help this particular client with their particular needs. And I think it would be something that many of you today would be able to understand the value of this as it relates to your particular needs, and seeing something on a proactive basis, again, that would help you plan.
Thanks, Todd. And again, wrapping things up, things are kind of quiet in the health and welfare area if you're a calendar year plan, and it seems like the summer is a nice time to not to think about it. But gosh, starting in September, it's a fire drill. And hopefully, with this type of advice, people can get started early. It won't be such a fire drill. I say that, but it seems like nothing ever changes.
That's right. Well, it certainly gives us some information to work with, and again, this will be archived so that people can go back right before that renewal process starts and maybe review this again. Before we close, a few quick reminders. First, you'll be getting a follow-up survey soon about this webinar. Please take a few moments to complete that questionnaire. As I always say, we truly appreciate your feedback, and we listen to all of your comments. And also, as I mentioned earlier, those who pre-registered for HRCI credit will receive an email in the next day or so with program details about today's webinar that they can use for recertification submission. And as I mentioned a couple of times, later this afternoon, an archived version of this webinar broadcast will be uploaded to our webinar resource page. The downloadable version of the presentation materials is also available there. Both of those can be easily accessed from the homepage of employerlink.com and McAfeeTaft.com. I want to thank Bill Frudenrich and Todd Neves for presenting today's webinar. And on behalf of the law firm of McAfee and Taft, thank you again for joining us for another Employer Link webinar. See you next time, and have a great afternoon.